Congratulations! Your loan is conditionally approved. A SunWest loan originator is always on top of her approvals, no matter where she is. Break free with Morgan.
Welcome to The Interest. I'm Sarah Wolak. After retaking control of Congress, Republicans are looking to dramatically remake the Consumer Financial Protection Bureau. But what would the CFPB look like if these proposals go through? And for that matter, what chance do Republicans have in getting support from Democrats, who still hold the Senate? Our own Mike Savino finds out in this edition of Ask an Expert.
I think what's really going to make a difference, if anything, is the decision of the Supreme Court and not what is going on in the House at this point in time.
Republicans aren't waiting for the U.S. Supreme Court. They're looking to take their own action on the CFPB, proposing a series of changes that would dramatically remake the agency. Attorney Jay Beidel says the biggest change would be giving agency control to a commission.
Right now, the director is kind of the ultimate authority under the CFPB structure.
This would mirror how the Federal Reserve and Securities and Exchange Commission operate now. Beidel says a commission would likely revisit rulings and regulations made under Director Rohit Chopra.
Certainly, the five-member board has more knowledge than the single director.
Republicans also want to take control of the CFPB's budget instead of waiting for the U.S. Supreme Court to rule whether lawmakers can hand over their power of the purse to the Fed. Other proposals include requiring the CFPB to consider how rules would impact small businesses, but Beidel says they already do that.
You know, the Republicans can pass anything they want in the House, but it probably would not be passed by a Democrat-controlled Senate.
Even if Republicans can get their bills passed in the U.S. House, Beidel doesn't think they'll get out of a divided legislature. And even if the Senate approved the same bills, President Joe Biden, also a Democrat, would still veto them.
The CFPB, to a large degree, it was done under Obama's term in office, and it's kind of the feather in the cap, if you will, of the Democrats.
You can hear more from Beidel on The Principle, available wherever you get your podcasts. For the Mortgage News Network, I'm Mike Savino.
Thanks, Mike. In other regulatory news, the FHFA is delaying controversial new upfront fees for Fannie Mae and Freddie Mac borrowers. Director Sandra Thompson says the agency will wait until August 1st to implement upfront fees for loans with a debt-to-income ratio above 40%. The change was supposed to start on May 1st. The fees were part of bigger changes the FHFA wants to make to the fee structure for the two enterprises, but it received pushback from the mortgage industry. MBA President Robert Brooksmith says the FHFA still needs to abandon the fees altogether because the DTI-based loan-level price adjustments simply are not workable for lenders and borrowers alike. He pointed out the ratio can fluctuate throughout the mortgage process, causing borrowers' costs to change. Coming up, Finance of America continues to struggle despite a shift in its business plan.
Tired of turndowns and wasting 25 basis points or more on slow and manual loan processing? Divorce your processor and break free with Morgan Chat AI. There are no bad deals or tough loans, only deserving families that need AI-driven fast and accurate service. We treat every client fairly and with empathy. AI that understands how you feel.
I am Morgan. I get you.
Welcome back. After suffering losses for 4 straight quarters, Finance of America decided to focus on what it sees as its bread and butter, reverse mortgages. So far, it hasn't been enough to end its losing streak, as Finance of America reported a $182 million loss for the final quarter of 2022. That means the company lost $716 million for the year. That is still an improvement from the $302 million loss the company had in the third quarter, which prompted FOA to end its retail and forward wholesale divisions. The company remains confident in its plan, pointing out that revenues from reverse mortgages went up. And whether it's reverse mortgages or HELOCs, many experts think we'll see a jump in homeowners looking to tap into their home equity. To help you take advantage of this trend, we've got 5 things you need to know as a home equity lender. First is the fact that homeowners likely won't be scared off by surging interest rates. Why? Personal savings is at its lowest since 2005 and credit card debt has spiked by 15%. Homeowners will want to use this equity to avoid draining their savings even further. On top of that, equity will remain strong even if the economy slows down. The average American homeowner has $217,000 in tappable equity. The third thing you and your borrowers need to know is that we likely won't see last year's historically low rates for a long time, even once inflation cools. The Fed is likely to bring rates down slowly. Next is the fact that refi and purchase activity will be way down as long as rates and home prices remain high. And finally, fintech investors are coming into the home equity lending market in a big way, making the loan process more user-friendly. You can get more tips at Mortgage Banker magazine, available at mortgagebankermag.com. We'll be right back with what else is interesting today. Welcome back. Here's what else is interesting today. Home prices may finally have slowed down, but last year's growth rates are still having an impact on rents. Adam says rents for single-family homes went up faster than home prices in 9 out of every 10 counties nationwide. That's good news for investors, as Adam predicts 3-bedroom rental properties will yield a 7.5% profit this year. It means investors can try to get a deal for their next property, but the same can be said for families motivated to buy a home instead of paying rising rents. For more on these and all of today's top stories, go to mortgagenewsnetwork.com.